Hello, good morning. I am Avnish Jain. Welcome to this monthly debt outlook from Canara Robeco. Much has happened over last month and all towards positive sentiments. Firstly, the war between US and Iran reached a tentative ceasefire with both sides agreeing for 60 days ceasefire to sort out various issues which have led to the war, specifically US not wanting Iran to have nuclear weapons and also trying to sort out situation between Iran and Israel, and also Iran's support of proxies in Lebanon and Yemen. The Strait of Hormuz was also reopened with ships going back and forth finally after 3 months, as both sides agreed to lift the blockade which had been there since the start of the war. Strait of Hormuz also remains a major point of discussion between US and Iran, as Iran wants to charge a fees for letting ships go through the Strait of Hormuz. This is not agreeable to either US or the European community, and it will be a very key point of discussion for Iran. US, on the other hand, has been offering other incentives like release of almost $300 billion of frozen funds of Iran. But US has made a condition that Iran has to buy only products from the US, which again may be a key point of discussion between both parties. There have been sporadic incidents of attack on ships in the strait, but these are very small. And last week, US and Iran again agreed not to create any further hostilities. This event led to major shift in oil price landscape. Oil prices crashed from about $90-95 a barrel before the ceasefire to now around $72 to $73 a barrel for Brent crude. This is a big positive for India. Overall, the global macro situation has improved after oil prices corrected, as it was having large impact, especially on the developing nations. India was the worst hit by oil price increase, and now situation should improve going forward as oil prices correct and the supply also restores back to normal in the coming months. From a rate perspective, US rates marginally came down. This is because US economy continues to remain resilient. Inflation in US also in the last print climbed to around 4%, which is much higher than a 2% target for the US Federal Reserve. The newly appointed Fed chairman was expected to toe the US administration's line of lower rates. However, the chairman pointed out that inflation remains above target for last 5 years, and his main job was to bring down inflation back to 2% target of the US Federal Reserve. This led to higher rates across the curve in the US, where we saw 2 to 5 year rates go on the higher side. Now any expectation of any rate cut in US is not there, while now markets expect that US rates may be hiked by end of the year 2026. In other developed countries also, we saw the UK Bank of England also pause on rates, while the ECB, the European Central Bank, is also expected to pause on rates in the aftermath of lower oil prices and end of hostilities in the Middle East. Coming to India, India saw a substantial flow of good news in last 1 month. In the monetary policy, the RBI governor unleashed a slew of reserves in an action to give support to the Indian rupee. The Indian rupee has fallen sharply against USD in the past 6 to 8 months. In February and March, it reached a high of around 97 to the dollar, and there was great pressure on RBI and the government to stop this fall of the rupee. RBI unveiled a slew of measures, including FCNR deposits at a concessional cost and also ECBs for PSU corporates at a concessional cost. In terms of FCNRB deposits, RBI removed the cap placed on bank deposits for FCNRB, which are in dollar terms, and they also proposed a swap facility for banks at zero cost for 3 to 5 years. This will enable banks to get FCNR deposits at a concessional rate and also get valuable foreign exchange into the country. In terms of ECBs, RBI is providing the concessional swap rates at 1.5% per year for PSU corporates to raise money overseas. All in all, market expectations are that amounts ranging from 40 to 50 billion could be raised through the FCNR route. In another move, the government removed taxation on FII debt investments in India, meaning there will be no capital gains tax on FII investing in India and also no tax on interest income. This improved the attractiveness of Indian debt markets as the tax on FII debt was one sore point with foreign investors. In the past 1 month, we have seen almost $5 to $6 billion of FII debt already come into Indian debt markets. Going forward, this will continue to support market as there is also expectation that Indian government bonds will be included in the Bloomberg Global Index, which could again attract more money next year. Overall, inflation remains on the lower side. The last number was just tad below 4% at 3.93%. RBI governor in the policy kept rates at a pause and also maintained stance at neutral. Just before the RBI policy in June, market expectation was that because of the war, oil prices were pretty high and they will lead to higher inflation. Also, rupee was under great pressure and market expectation was that RBI may need to hike by 50 to 100 basis points in 1 year to control both inflation as well as the sharp depreciation of the rupee. However, post-policy, RBI governor in one media interview also pointed out that rate hike expectations were pretty premature right now and market rates could remain lower as inflation was well within 4% target. The market had to reprice all expectations and now market expectations are of about 50 basis rate hike and that too at end of financial year, probably starting from December policy. The yield curve reacted to the changed expectations very sharply. Short-term rates moved down by about 50 to 70 basis points in the corporate bond space, while on GSET curve we saw market yields fall by 20 to 30 basis points across the curve. Because there were two factors at play. Once there were the revising of expectations where rate hikes were now on the lower side. Also, FI inflows were expected to come on a regular basis now as the taxation angle is now out of the way. We saw 10-year yield drop from about 7% to around 6.75% now, and other 1-year rate also dropped from about 6% to about 5.60. Overall, the situation has reversed from earlier and we are seeing positive sentiment in the bond market. Going forward, markets have already corrected for the change expectations. So we would expect now that markets will react more on an upcoming data, especially inflation. Fuel price hike is still not built into inflation which had come earlier, inflation prints which had come earlier. So we would expect some jump in inflation in the June number when it's announced in mid of July. So on the supply side also, government had only budgeted 51% of supply of total borrowing in the first half of the year. Second half will bear the brunt of supply both from the government and from the state governments. This would likely put pressure on yields. However, markets expect that increased FI flows in coming months could offset any increase in supply pressure. Overall situation has improved vastly for debt in last 1 month. However, markets have already corrected for the sharp increase in yields from the start of the war in February. Markets are now at pre-war levels in terms of 10-year yield and we don't expect any sharp drop from here. Going forward, we would expect markets to now consolidate at the current levels. We would see 10-year probably trading between 675 to 685 range in the near term, as FI flows would likely keep market supported. Inflation numbers coming out in the next few months are likely to drive market direction. It is expected that RBI policy in August, RBI will continue to remain on pause mode, waiting more data. The large deficit in monsoon also will play out in coming months. Right now, inflation in the food prices is still under control. However, if monsoon continues to remain in the deficit zone, we could expect pressure on food prices. The government has enough buffers to manage that. However, there could be impact on inflation going forward if monsoon continues to be on the lower side. The Super El Nino phase will start in July, and we have to see how it could further impact the already deficit monsoons in India. From a fund perspective, investors may choose to invest in low duration funds, short duration funds, and corporate bond funds. As usual, investors should look at their investment horizon as well as risk appetite when looking to invest in debt funds. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.